Let's get started. Welcome everyone to this week's Multifamily Monday from the Multifamily Investment Advisors. Glad to see everyone here. Just wanted to come in and kind of give you guys a quick market update, what we're seeing in the market, talk about a few investment opportunities, some of the excitement around the Chicagoland market, and see if we can get some interaction and some participation from some of the team that's here. Why don't I kick it over to you, Travis?
Thanks for that introduction there, Tony. Yeah, we're going to start off this webinar actually passing the ball to our Director of Market Analytics, Drew Heitzman, to give us an update.
Sure. Thanks, Travis. Good afternoon, everyone. This is Drew Heitzman speaking. Would you be able to pass me over the screen share capability?
Sure. Let me work on that. I think today. Here we go.
Awesome.
Zoom, one second, screen share. Done. Should have it.
Cool. Okay. So here's the last 5 days of the 10-year yield, which is dipped to the low of the last week was about 1.56, which is 3 basis points lower than what it currently is at 1.59. The Fed continually reiterates that they're not looking to increase short-term rates, which would have an impact on the 10-year, but a big indication of that and a catalyst for the 10-year Treasury will be the Consumer Price Index report on Wednesday. And that report's pretty much going to show how prices have increased or decreased over the last month. It's a month-to-month report. So that report will give us an idea of whether inflation is a concern, which I think we can all agree that based on commodity prices hitting all-time highs, it is something to look out for. And like I said, higher inflation is going to lead to higher interest rates, both short-term, and that will have an impact on the 10-year Treasury. So that Consumer Price Index report is something to look forward to, and that will give us an idea of where the 10-year will head over the next few months and the next year or two. Thank you.
Thanks for that update, Drew. What we're going to do now is pass it over to Vince. He's our Director of Dispositions. He's going to be giving us a little bit of information as to what investors are actually seeing for trends out here in Chicago.
I appreciate that, Travis. If you'll pass the screen share to me, that'd be amazing.
You should be good to go.
Okay, good deal. What we have here is a bit of can you guys see this slide? I've got this big, beautiful room for growth slide.
That's fine. Yep.
Amazing. Okay, so what we see with Chicago as the third largest metropolitan area in the United States is room for growth in comparison to other cities with similar population density and size. Chicago is coming in at just over $300,000 for your average purchase price for investors. Compared to LA and New York, that is exponentially lower. What that means for our investors is there's room for value add, there's room for appreciation that can be forced. It is one of the few cities in the nation where housing prices have not risen over their 2006 levels. That is a phenomenal attribute for our investors coming out of California, coming out of Washington, all over the West Coast, additionally coming out of New York. In New York, I just spoke with an individual that told me that the progressive, kind of legislation atmosphere that they view in the Illinois area, especially Chicago, is comparative to how many, Chicago investors may view Texas, kind of like a free-for-all and just room to grow. I'm getting calls from all over, so that's an interesting thing. There's still an availability of under market value properties. As you guys know, in California, that does not exist. In many cases, they're buying at negative cap rates. Here you're seeing cap rates that exceed that of, a metropolitan area of this scale. And Business Insider magazine, as you can see at the anecdote at the bottom, did rate Chicago as one of the top 5 places to buy rental properties. That's a phenomenal kind of rating. We're going to switch over to this next slide. As far as the renter pool, phenomenal. Chicago is still one of the few cities as well in which renters are spending less than 20% of their income on rent. That makes it a very competitive place for the, kind of transitional work field that you see in the millennial space and the Gen Z space now coming into the workforce. Your typical renter spends that less, and over 50% of the population is renters. Many factors guarantee that those renters, unfortunately for them, but fortunately for the investment population, will not become home buyers anytime soon. They're straddled with student debt. They kind of do want to be transitional and able to move between city to city. And the ROI is likely going to be high and likely improve over time based on many predictions. In addition to that, other accolades for the city, have included that, it's one of the top most high-tech cities, according to Fortune magazine. It's on UBS list of one of the world's richest cities, and often rated as one of the most balanced economies in the United States, headquarters to 36 Fortune 500 companies. We're seeing development skyrocket in areas like Rogers Park, Logan Square, Pilsen, Avondale, Humboldt Park, and Westtown. All the time I'm getting calls from investors, hey, do you have anything in these notable neighborhoods and the surrounding areas? With, the sort of pilot programs we're seeing with ADU, as well as opportunity zones, not only appreciation occurring in those areas, but in the surrounding areas. Chicago's a hotbed, and obviously we see news reports that create suspicion and kind of doubt, but honestly, the optimism coming from out of town and for informed folks like our listeners here that are local, we're definitely seeing more optimism than the opposite. And that's kind of my report for today.
Thanks for sharing all that great information there, Vince. If you like that quick slideshow presentation that Vince actually went over there, please feel free to shoot him an email or give him a call. He's going to drop his contact information into the chat bubble. And what we're going to do is we're going to move over to our executive director, Tony Hardy, to share some information regarding the multifamily market.
Sure. Thanks for that, Travis, introduction. Just want to kind of reiterate and touch on some of the topics that the guys talked about today, beginning with Drew and his capital markets update, discussing the consumer price index and the 10-year treasury yield, and inflationary pressures in the marketplace. We have been seeing inflationary pressures in the marketplace, not necessarily anything to get alarmed about, probably anticipated. I kind of anticipated inflationary pressures when we were rolling out trillions of dollars, right? When there's more money in the ethos, the price of things tend to rise, right? And trillions of dollars is no small feat. And we have been seeing the price of lumber skyrocket. However, building is continuing to happen. I think a lot of the apartment units are still turning, right? There's still construction happening. However, the price of construction materials, lumber in particular, is rising. Another great reason to look at real estate as an investment vehicle. Real estate is a great hedge against inflation. A lot of retail leases have clauses built in, or where they tick up 3% a year to keep up with inflation. Some of them have as bumps built in as the tenant begins to hit certain numbers. Say you get over $1 million, the property owner may get 2% or 1% of gross, things like that. As inflation comes in, the price of things costs more, it's more likely that they'll hit those numbers. Now we do have a little bit of a challenge with rent increases in this market, but at some point, as things cost more, so does rent. So we should be okay. Traditionally, real estate has been a great hedge against inflation, but we are starting to hear more and more about that in the media, in the news. The job reports wasn't exactly what we anticipated this past week, and that is affecting consumer confidence. But I think we'll be okay. I mean, it's like our economy's just been kind of hockey sticking here for a while, and you're starting to see a little bit of a moderation. ADU pilot zones throughout the city. Applications open May 1st. That's exciting. A great way for owners in the 5 neighborhoods that have the ADU pilot zones and qualified to force appreciation, right? You could either add garden units, you could add units, you can build a coach house in the back of your property and increase the value of the property. The ADU pilot zone is a great program. We've been getting really good feedback from investors that are looking to tap equity or looking to add value to their properties. If you have questions about the application process, some of the details, like if you add 2 units or more, 50% of the units need to be affordable housing. Part of the reason for this whole thing anyway is that we are in an affordable housing crisis, right? So, but garden units are typically naturally affordable, naturally recurring affordable units, because with it being a garden unit, it's typically rented at a lower price per foot than the units above grade and the other units around the neighborhood. So shouldn't be too much of a challenge, but if you want to talk to us about the details about that, the members of the team are happy to discuss. As far as the overall Chicagoland real estate market is concerned, we have been encouraged to see the downtown investment or the downtown rental market rebounding a bit. I think as we came into 2021, where we're seeing high vacancy levels left off from the pandemic, I think we're seeing big concessions made in the last 2 quarters of 2020, and really not a whole lot of activity on taking them up on the concessions. But we have been seeing the millennials, some other groups moving into the downtown market, taking advantage of some of the concessions. That's encouraging. Also, the south side of Chicago, the west side of Chicago continues to outperform. We're continuing to see an increased investor demand in those markets, some of the lowest vacancy rates on history. Coupled with, there are some challenges, right? There are some people feeling some pain from the pandemic, and economic occupancy levels may not be on pace at the same rate as the physical vacancy. However, still encouraging, still strong numbers, and most tenants are doing the right thing. And the programs from the city, state, and local are set to come out mid-May, which should give some tenant rental assistance relief, which is much needed. One program in particular gives up to $25,000 in rental relief, can let the tenant look back and catch up rent from 12 months behind, and even help them with their rent 3 months going forward if they're having ongoing problems from the pandemic. A large concern of some of the property owners is still, what do we do about squatters, and what do they do about tenants that were in trouble before the pandemic? Because those squatters don't qualify for rental assistance, and neither does pre-pandemic people that couldn't say that the pandemic was the reason they were having problems. The Multifamily Investment Advisors continues to see robust activity throughout the Chicagoland market. We have multifamily investment opportunities available in markets all across the city and suburbs, including Dalton, Aurora, the South Loop, South Shore, Auburn Gresham, and several other markets. If you're interested in any properties, 6 units to 106 units, we have ready market available properties that we'd like to get in front of you and discuss. Also, later this week, later this month, the Southside Community Investors Association, Thursday, May 27th, is having its Thursday meeting in conjunction with the Greater Chatham Initiative. We're going to have economists come in from DePaul University to talk about, to deep dive into some of the metrics affecting Chicago real estate, in particular, Southside real estate, in particular, Chicago real estate in general, to follow up on last month's discussion from CoStar Group, deep diving into some of the metrics in Chicago multifamily investments and what to expect, forecasts, and those things. Those replays will be available on our YouTube channel. For those of you who didn't attend last week or can't make it this week. I want to kick it back to you, Travis. Maybe we can get an update from Jerry Brown, one of the more notable tax attorneys in the city of Chicago, eager to help us out in figuring out this web that we weave.
Can I jump in?
Go for it.
One question in particular, I didn't attend this event, but someone else who did, and it was addressed by Treasurer Maria Pappas. And she was raising the concerns regarding what's likely to be a prolonged pattern of increases in property taxes based on the city's unfunded pension liabilities and, of course, the difficulties in funding the schools. So she's worried that the property tax is going to continue to go up no matter what the assessor does. That's a whole other discussion. And I'm curious as to whether others on this Zoom, are you getting much in the way of commentary or resistance from people who are concerned about these structural issues that would drive the property tax liability upward?
We are getting some concerns from investors that are concerned with the unpredictable nature, right? They can't understand where taxes are going or the rhyme or reason on where they are versus where they're going. If we had some more guidance, I think I'm on a call with you every couple days trying to figure out 6 flats, 20 units, and how this all works. It would be helpful, right? Because investor confidence, a lot of times they need to be able to create a roadmap. So that part of it is challenging. We do have investors every day calling us saying, "Hey, we're out, right? We're done with this marketplace, and we want to have a conversation around maybe putting some property on the market." So far, there has been, for every one investor getting out, there has been several investors looking to get in. So we've been reaching a little bit of an equilibrium in that regard. However, there has been a disconnect in seller expectation and buyer expectations. And part of that is because of the unpredictable nature in between. Property taxes being the largest line item, typically on your expense statement, is a big concern, followed by the water bill. This is typically your second line item. Used to be the gas bill, but unfortunately, the price of water has increased over the last 3 years, has increased 300%. So when you look at something like that, that's inflation, right? The cost of water going up at that rapid rate, you can't increase rent 300%. You can't increase anything else, especially in a pandemic. If rent is held flat and your taxes are going up, your water is going up, the cost of operating is going up, at some point, some of the smaller owners, I am concerned about some of the smaller owners and some of the people that some of this legislation purports to protect having some unintended consequences.
Okay. Thanks. That's very helpful to know. And let me make an offer because I'm always researching this area. If there are particular issues or questions you'd like to see some more developed research on, let me know, because I have some people here working with me, and we're happy to do the research. I mean, it's part of the ongoing conversations we're having with our clients, and we're looking to buy new things. So if there are particular questions that you think we might be able to provide some additional insight or research on, let us know. We'd be happy to try to provide that for you. And one thing about the current Mayor Lightfoot's team, and I don't have any connections to anybody on her team really, but they do seem to be sensitive to not dramatically escalating the property tax levy. Because I remember 2 years ago, they said there was the budget shortfall of $800 million. And there was a lot of worry that she's going to try to make that all up just by putting it on property taxes. They didn't. The increase was a fairly modest one. They found other ways of getting revenue, and they seem to have done something similar this year. So while those pressures are very real and they're going to continue to be real, it seems that the city is determined to not see the negative impact it would have by just really having a dramatic increase in the levy. How long that they'll be able to continue to do that, don't know. I'd like to see it, but I'm not as concerned as I would be if we had seen, huge increases. Because you may remember in the last several years of Emanuel's administration, he did a really large increase to fund the firemen and teachers plan, and he spread it out over 4 years. So we've not had that again, and I am watching that pretty closely.
Yeah, thanks for sharing that, Jerry. That is some of the commentary and feedback that we've gotten even while we were going through that situation, was that they weren't, gouging us, so to speak, that they were trying to be careful and conservative to do what was necessary, but not to overdo it. And we do understand, at least the consensus is that there is an understanding that there's got to be some of this that happens, and it seems like for the most part it's been responsible.
Okay. Actually, I'm going to be speaking at this organization called the Illinois Industrial Roundtable. We meet every quarter to discuss, the financial conditions, and I do it from the perspective of property taxes and real estate. And what I've been telling them the last couple of years is you have two narratives going on in Chicago. On the optimistic side, pretty much in line with your remarks earlier, and others who see all of the advantages of being in the Chicago market. And then there are the others who point out the crime, the fiscal situation, the pension liability, and all the rest. And you have a number of people in different camps responding to those two scenarios in different ways for any variety of reasons. I mean, there are people who are eager to get here or stay here. There are others who are leaving. So you have two different stories going on at the same time.
Yeah, I think Vince touched on that earlier. It's a really dynamic city. I'm always on the phone with investors, and one of the main drivers for the city of Chicago is population, right? Our population is within, some of the cities that they're talking about going to invest in, our neighborhoods have more population than the entire city. So if you got population, you're going to have renter demand. We also have 77 different neighborhoods to choose from in the city alone, and those different neighborhoods gives you a kind of a sample of the diaspora of the country, so you can kind of pick your poison as far as investment criteria, investment yield, and then we have a steady flow of talent coming out of the excellent universities we have in the city and the region, and I think that continues to attract strong employers. Our unemployment rate continues to be strong, a little bit ahead of the natural average. Our dollars, as far as what we're paying, continues to be a little bit ahead of the national average. And then when you look at the cost of living here, albeit taxes, albeit some of the other things that are going on, it's less than a lot of cities the same size as Chicago, when you start to look even some of the smaller cities like New York and some of the other areas. And temper investors, especially commercial real estate investors, this isn't a fix or flip business. It's a long game. And if you're looking at this based on what you think is going to happen in the next 5 minutes or the next year or so, then this isn't what we typically do this for. We're typically looking at a 5-7 year horizon, and then cities are managing cities based on a 25-50 year horizon. So you kind of gotta look at things in perspective.
Thanks. That's good to hear.
Yeah. So again, I want to pass it back to Travis. I think he's gonna close this out.
Yeah, thanks, Jerry and Tony, for sharing that information today. Just wanted to make you all aware of another event that's upcoming by the Neighborhood Building Owners Alliance Group. They're going to have a webinar on tomorrow's date at noon, where they're actually going to be discussing the City of Chicago Department of Housing and their emergency rental assistance programs. Definitely a good webinar to tune in. And of course, we look forward to seeing you all next Monday at noon, where we're going to be presenting the multifamily market update. Thanks, guys.